Hi everyone, hope you're doing well. Welcome to the most popular video series that I do on the YouTube channel, which is the Stocks I'm Buying October 2024 edition. I did my UK one a couple of days ago, but this is going to be all the US stocks that I bought and sold during the 1st of September to the 1st of October. I've done this series on the YouTube channel for nearly 8 years now, which is a pretty long time, and it's just a good way to keep up with transparency, because if anything I've bought, it'll be on this video. If I've sold anything, it'll be on this video, and you guys can track along with how I'm doing in the stock market. And I don't hide anything. I don't turn up in 2 years time and go, oh, by the way, I bought this stock a long time ago and now I'm up this much. I don't do that. If I bought it, if I sold it, it'll be on here and you get to see in real time if it worked out or if it didn't work out. So I hope you enjoyed the series, guys. Let's get started. Now, as always, if you do want to see what I'm buying and selling in real time, join the Patreon, link is in the description. £5 a month. On there you get to see my live buy and sell alerts, so you don't have to wait for this video. You get a Discord with 500 members on to talk about stocks, including me, and you get 2 exclusive videos a week. That's all for £5 a month, the price of a pint. That's why it's the highest YouTuber to subscriber amount out there on the whole stock market scene. And as well as that, you do support the channel as well for all the content I give you guys. I'll also drop another video this week on the weekend, and I'll also do the live Q&A 16,000 subscriber special on the YouTube channel on Sunday for you guys, so keep an eye out for that. And if you do want to start investing, join Trading2 with the link in the description. Personally, that's the investing platform that I use. If you join through the link in the description, you get a free share worth up to £100. Let's get started on today's video. So first of all, I was trying to keep this a little bit surprised, but I did drop it in yesterday's video by mistake. Yes, Hims & Hers. I did buy some Hims & Hers. The first time I have bought Hims & Hers since October 2023. Nearly a year ago is when I last bought Hims & Hers, and I did go in with a buy in the last month for Hims & Hers. The last time I bought, the stock was $6, but I have come back in and started buying. Now, I didn't buy at the current levels. I did buy around about $13, low $14 range, and that's where I'm quite happy to buy Hims & Hers, and I'll start building that position up. It's my second largest position in the portfolio. It's done very well for us. We're up still 140, 150%, 160%, something like that. And these times I've actually sold this position, some of my position out for like 300% return so far this year. So it's been absolutely insane. But when it gets back down to these levels, I think, you know what, this is actually quite an attractive value, and I'll nibble some shares in Hims & Hers. So if it does get back down there, that's where I am going to be a buyer of. And it is my second largest position, but I would actually take it as my number 1 position in the portfolio, because for me, this is the stock that is the best financially performer in my portfolio that I've got. The last 2 years of this company has just brought 10 out of 10 earnings reports, and if there's any weakness in here, I'm going to buy it. Now, I'm not going to mention today about the GLP-1, because I did a video on it the other day, and I think that's absolutely stupid. The drop that's causing at the moment, that's obviously always going to be a short-term issue. While Hims have access to it on the shortage list, we knew that wasn't going to last forever, and even so, even if we lose access to the GLP-1, it only makes up 5% of the revenue. Last quarter, it only contributed 15 million of revenue when they made 350 million. It's stupid, and I'm not going to focus on that today. But if you do want some thoughts on that, yesterday's video is a one for that. But Hims & Hers, getting on to the actual long term and the success that they've had in the last 3, 4, 5 years, how is it doing so well? Well, Hims & Hers is a telehealth business. They give easy access to a lot of medical care, and what we see at the moment is the younger generation want easy access. They don't want to go and travel for ages to get some healthcare access. They want to be at home, they want to use a mobile phone, easy access, and when they want the medical care, they want it to be convenient, and as well as that, they want it to be cheap, and Hims & Hers provides all that telehealth service for them. If we look at the moment, there has been very good growth in subscribers, as well as growth in personalized products. And here you can see some of the latest launches that they have currently done as well. Looking at the financials, 41% subscriber growth, 46% out. This is off Q1 numbers as well, by the way, not Q2 numbers. 46% revenue growth. This is before GLP-1, 8.4 adjusted EBITDA margin, and you can just see the improvements from the year before. 90% reoccurring revenue, 75% gross profit margins, and 1 year payback as well. Those are very pretty reading numbers, aren't they? When you look at the scalability of adjusted EBITDA, they are now entering their profit phase. We've had the revenue growth phase for the last 2 years. Now we're entering the profitability phase, and you can see here the profitability is ramping up and ramping up very fast. The reason why is because they're now getting marketing leverage. Basically, they don't have to increase the marketing as much, and the marketing is supporting all the new growth. They're generating good amounts of cash, and that is also enabling them to go buy back stock. They just recently announced another stock buyback, which is very good. Looking at the long-term numbers, they are expecting long-term adjusted EBITDA margin to 20 to 30%. So if we do look at what they've just done, 8.4%, they are expecting very big amounts of increases in that profitability, and no wonder why. When you're expecting gross margins of 70%, there's a lot of room for improvement there with the profit margins, and that's why personally for me, I always put in 10% profit margins in the long term. Right now, Hims & Hers is currently trading at 45 times forward earnings, which is ridiculous. A company like Hims & Hers that has executed how they have done, and they have just come off 46% revenue growth. Even with the latest quarter, I think it was 44% revenue growth without the GLP-1. Picking up a 40% growth company that is growing the profitability as well at these sort of rates at 45 times forward earnings is crazy. Like, this should be a lot higher. And when you look at the scale they're growing at and the profitability they're growing at, it's going to be very easy for them to make this stock look very cheap. And that's why I believe Hims & Hers. I buy Hims & Hers for, obviously I always buy a stock for 100% return. It's the one stock I own that I would actually be disappointed with only 100% return. I would like to see Hims & Hers come to be a 5-bagger for me. It's probably the stock that if I'm going to outperform the S&P 500 in the next kind of 5 years, and like how I did last year, a lot of that, the reason why I outperformed the S&P 500 last year, it came down to this stock. And my feeling is that if I'm going to outperform the S&P 500 this year, and if I'm going to outperform it in the future years, it's probably going to go down to this stock, really. The recent earnings that we did have, the Q2 earnings, absolutely amazing. EPS beat, revenue of 51%, as you can see here. Outlook, a massive hike on Outlook, which they seem to do every single quarter now, is hiking up that Outlook, absolutely amazing. And as well as that, clean balance sheet. No debt on there, as you can see here. So all this profitability that they're starting to generate now, which you can see the growth and the revenue growth starting to come in now, is all going to the bottom line. That's going to generate obviously a bigger cash pile, and with that cash pile that they have, which is around about 227 million, they're able to throw that into share buybacks, which obviously they're starting to do. You've got a founder-led company as well who owns a good chunk of the business. He does still own. People keep saying, "Oh, Andrew Dunham selling shares." Yeah, he sold 2% of his position. Like, even I've sold more than that, and I'm just as long as a shareholder as what Andrew Dunham will be, and he still owns 8% of the business. So it's great to see another founder-led business there. I love Hims & Hers. Next one, Google. So Google was bought this month as well. This one had a dip. Start of September, the stock did dip into the $149 range. I did buy a bigger stake into Google. It's a stock that I have owned for a while. I'm up once again like 40-50% on the position. It's had a great year since I did start buying it. Then it just fell off the cliff. It had a 20% crash, and I thought, you know what? I like Google at $152. So I did buy some more shares into Google. Google owns a lot of products. You're probably using one right now because you're on YouTube, but right now I'm using one because I'm on Google. As well as that, there's the likes of the cloud. You kind of forget they actually own Fitbit as well, and Nest and Waymo, which is something that I don't really focus on. If Waymo does come something successful with the autonomous cars, hey, that's a bonus to me, but I actually don't really factor it in that much into my projections. But it's a nice bonus sitting there that if that is successful, that could be a really good driver going forward. But when the actual financials start coming in, that's for me. You know, people sometimes hype up something that may happen. For me, I always price in what is happening, what can I see happening. And right now I can't see that much happening, but it's a nice little bonus to get for the current value in the company that I'm currently getting at the moment. Google's numbers recently, absolutely amazing. EPS beat by 0.04, revenue growth of 13.6%, 450 million. Obviously with Google as well, you're picking this up at 23 times earnings, you're getting a dividend yield, as well as Google having great growth from its YouTube, obviously it's Google Search. Google Cloud is a big growth driver for them at the moment, as you can see here. And look at the profitability increase in the latest quarter. The profitability nearly 3x'd in the last quarter, which is going to be a key driver for them going forward. You're picking all this up at 19 times forward earnings. Now, obviously, I bought it a little bit cheaper. It's around about 17 forward times earnings. for me, 17 forward times earnings for Google with YouTube and also the search, your potential of Waymo, your potential of Google Cloud that's ramping up massively. This is a premium company. I would say Google's probably the top 3 businesses in the world, and I'm picking it up for below market average valuations. And when I did buy it, it was way below market average valuations. This should not happen. You should not be picking Google up at these levels that's growing at 13.6% with the dividend, the share buyout. It shouldn't happen. This company should be trading at like 25, 30 times earnings, even on a forward basis. This is a quality business, one of the best out there, and yet I'm picking it at these levels. So you know what? If you're giving me that gift, I'm going to take that gift. Look at the shares that they've been buying back as well. This is obviously a great contributor to the profitability levels, the EPS levels, which is great. And they do that because they generate so much profitability. You look at the profitability they're generating every year. They're making 95 billion a year. With that 95 billion, they can go buy pretty much nearly every company out there that they want to buy, which is the crazy thing. And that just leaves them so much options. They've got a great balance sheet. The cash is, really healthy. 100 billion of cash. They could throw that 95 billion anywhere they want to every year, which is just such a good thing as a shareholder. So I will continue to buy Google if it gets to really nice levels like that. Next one, Disney. The first time I bought Disney for a little bit, I can't remember the last time I bought Disney, but I really think it would have been quite a few months ago. Yeah, I did buy Disney. Same again. It was having quite a bit of weakness at the start of the month, back into like that $80 range, and I thought, you know what? I'm going to increase my Disney position. Disney, I feel like, will be around for many years with the brands they currently have. And the fact that Disney have gone back to paying the dividend, it is now way below the share price before they even announced Disney Plus. It's really surprising to me. And right now, Disney is currently sitting at 18 times forward earnings. It owns so many brands. You look at the brands they have, you forget like the quality of brands between the Disneyland parks they have, the Lucasfilms they have, Marvel, ESPN. Pixar is quite a big list of brands. I think these brands alone, if they were to break them up, is worth than the current market cap. And you look at the potential of the characters they have to tap into at the moment. There's such a great list of characters as well that they can continue to use going forward. The big thing I think Disney had wrong is I think the content went a little bit sideways. I don't think they generated the best content they could do, and hopefully that's going to happen. There's going to be times where your content goes downhill a little bit, but I feel like the current slate coming up will actually be pretty good and should hopefully start generating more profit and revenue for them. Obviously leads to the parks, the merchandises, the cruise ships, and I think the list looks pretty good going forward. But even during this bad time, we say, of content from Disney, they're still achieving like pretty good content. Like Inside Out 2, Deadpool, Despicable Me 4, I believe they own Despicable Me 4. They have like 3 of the top 10 grossing movies this year, which is supposed to be the bad time they currently have. And then they brought Bob Iger in. Bob Iger was brought in to replace Bob Chapek. He said basically we're going to go back to what we used to do, which is dividend, focus on profitability, and that's what you're getting now, Disney. You look at the recent numbers, the growth, maybe a little bit slower than what you'd want, maybe a little bit higher, is 5-6%. But we're going through a bit of a weaker time. People aren't going to the parks as much. That will kind of slowly recover going forward. But on a profitability point of view, net income in the latest quarter went from a 0.1 billion loss to a 3.1 billion gain. Diluted earnings per share was a loss of 0.25, now went up to $1.43. Everything's moving in the right direction with Disney. So I'm looking at this right now and I'm thinking, what we were expecting to see from the return of Bob Iger is happening. He has transformed the business getting back to the roots of the good content, getting the dividend back, ramping up the profitability, and the fact that we're getting Disney back at the prices it was before even Disney Plus was launched is just crazy to me. So, I think it's a great brand that will continue to execute very well in the next 3 or 4 years. The next one is Ulta Beauty. I did buy some Ulta Beauty. It had a little bit of a wobble during the start of September, as you can see here. Did rally back up again. Has come down a little bit in the last couple of days, but it's still up from where I did buy. It's a bit of a new position for me. I'm not copycatting Warren Buffett. I was actually interested in this before Warren Buffett announced he was buying it, as you guys would have seen on the YouTube channel. But obviously it's really good to see that Warren Buffett, or Berkshire Hathaway, people get upset if I say it's Warren Buffett buying it, Berkshire Hathaway are buying some shares into the stock, and I can see why. A lot of things to like here. Ulta Beauty, obviously a seller of makeup brands as well as other beauty services at the moment. And they have done very well to survive. You know, we've seen a lot of brick and mortar stores struggle. Ulta Beauty hasn't struggled. The reason why is that people still like going to buy makeup in person. They like seeing it, they like trying it, as well as that they do actually have a good digital strategy. Their sales are actually a big contribution of the revenue. So they've actually transformed into a revenue business from an online point of view as well, very well, and also social media expansion has been very good for them as well. They're also going to expand into Mexico, so you kind of get worried about how many Ulta Beauties can still be expanded into the US. Well, if they're opening up into Mexico, that should hopefully be very successful for them. And as we look at the Piper Sandler Teen Survey, you can see here that beauty still remains a higher priority with the wallet. Beauty consumers still prefer to spend in-store versus online with an 85 preference. That's very impressive as well. And as well as that, when you do look at Ulta Beauty, it's still the number 2 top beauty destination. So they have had some competition with Sephora, and also there's that weaker environment out there at the moment. But when you look at Ulta Beauty, if it holds somewhere around this 31% share, is still going to do very well going forward, in my opinion. And once it's got these tough comps out of the way, I think we should see the company return to growth and the profitability going up, and hopefully the new plans that they have will help them do that. And at the end of the day, I'm not going to panic too much because I'm buying a company with a clean balance sheet. They've got no debt on there, and a nice little healthy cash balance, which they have been putting back into share buybacks, which you want to see from a company when their stock is at these sort of levels. So yeah, big fan of Ulta Beauty at the moment. I would like it a little bit cheaper now if I am going to carry on buying some shares though, so we'll see what happens. Celsius, I did buy some Celsius. The stock has had a tough time at the moment. This was a stock that did very well for me. I bought it in 2022. I actually sold out my shares and I was like, oh, maybe I've sold a little bit too early, and I thought I made the wrong decision, but hey, it actually turned out to be the right decision. I then did start buying into the stock, but the stock has actually fallen below where I did start buying back into the business, which is a big surprise to me. I always thought there was a risk the stock could go down a little bit here because it was a bit of a premium valuation, but now it's fallen all the way down to $29, which is a big surprise, and I've took that opportunity to buy back into them. I'm sure most of you guys are aware they are a energy drink company. They sell these energy drinks, which I think are very nice. I personally would take a Celsius over a Red Bull and Monster, so I'm a big fan of them. And if you actually look at the market share, at the moment, I've got a paywall coming up. Look at this. How annoying is this? But the top bar is Monster, the next one's Red Bull, and the next one is Celsius. Celsius is still currently only around about a 5% share, and this is from 2023, so it has got a little bit closer since, compared to like Monsters and Red Bulls, which is far ahead. But actually, when you look at like a teen survey, once again, Celsius is the favourite energy drink from the teens, which is key. You want to be in with the younger audience, and as well as that, when you look at compared to the likes of Amazon, Celsius is actually now ahead of Red Bull, and it's actually only 2% behind Monster. So when we look at overall, overall it's quite far behind at the moment. If you look here, Celsius is only around about 5%. Sorry, the paywall popped up again. Compared to like Monster's like 30%. So overall it's quite far behind Monster still, but that's because when you think about it, if you go into stores, Monster's stocked everywhere. At the moment, Celsius isn't stocked everywhere at the moment, and that's what's going to close the gap up to them. And when you actually have the easier accessibility to go buy some like Celsius compared to on like Amazon, it's very, very close at the moment. So as soon as Celsius gets into more and more stores, I think it'll come the number 2 behind Monster. There's a lot of expansion for it going forward. The recent earnings were okay. EPS beat, which was nice, 23% year over year revenue growth, as you can see here. Forecast to drop off a little bit at the moment going forward, but there is a rebound expected in 2025. The reason why there's a bit of a drop off at the moment, and that's why the stock is dropping down, is because Pepsi bought a stake in Celsius, which is probably positive that, even Pepsi is staring at Celsius going, if they're buying a stake, like, we really like this business and we think it's got a lot of potential. But they also took over the distribution. What happened is Pepsi bought too much inventory, and now it's going, you know what, we wanted to buy a lot of inventory, so we didn't have any shortfalls anywhere when we took over. but now we actually need to reduce it. And because Pepsi aren't ordering any, that's affecting the sales of Celsius at the moment. And once that inventory issue is solved, that's why it's forecast for Celsius to go back up to good amounts of growth. So I think you'll be okay in the long term. Right now, you're picking up at 31 times earnings, which compared to Monster's earnings is 26. But when we look at the comparison of the growth, Celsius is currently trading at like 20 times the growth of Monster. So very nice valuation. What happened is Celsius have also expanded into Canada recently. That started in January 2024. That's going to be a great expansion for them. I think that'll be very easy for them to expand into Canada. Very similar to the US market, and probably a lot of people that live to the south of Canada probably travel to the US and probably already buy Celsius, so that'd be quite easy for them to expand to. UK, on the other hand, is probably the bit that I am a little bit nervous on. I've called this out on the YouTube channel. They have expanded into the UK, which is good. However, the problem is that, as I posted on X, is that I think the UK launch has been a little bit disappointing, and hopefully they resolve this. I feel like the flavours they have chosen have been pretty poor, and I think the marketing is also pretty poor at the moment. So hopefully they can make sure that this improves, because it will be a great expansion for them. Even if the UK expansion does fail, I think Canada and the US alone has enough to carry this stock going forward, or this business going forward, because that has growth potential, or massive growth potential. And you can see analysts are still very bullish on the forecast. Balance sheet wise, it's got a cracking balance sheet, as you can see here. No debt on there. They do have a lot of cash. They have 903 million of cash. I would like them to start throwing that into a share buyback. We'll see what happens there. And that leads me on to the stocks that I have been selling. So I did sell 2 stocks. I sold the 2 positions out completely during the last month. I've covered these previously on YouTube, which the first one is Starbucks. I did sell my Starbucks position for a quick, nice bit of profit. Only started buying not too long ago, at the start of this year, or at the spring of this year. The stock very quickly rallied up on the news that there was the new CEO coming in, and it went up to 26 times earnings again. And I just went, you know what? It's already priced at a premium valuation. The growth hasn't come back yet. Like the EPS is still dropping at the moment. The revenue growth is still flat. Analysts are a little bit more bullish for next year, but are they going to get there? I don't know. There's a lot of competition aspects. I just went, you know what? I made a quick profit here. I'm going to take it out here because I'm nowhere close to buying it. And the fact that it's already at a premium valuation without the proven growth back, I'm going to take a quick profit here. So I did sell my Starbucks position, and obviously the next one I sold was PDD. It had a big drop off their recent earnings. I saw the earnings and I thought they weren't. The recent earnings were good. The problem is the guidance. PDD don't offer any guidance for the going forward, and in the recent quarter, all they said is that we might have declining profitability, and I was like, well, how long is that going on for? How big are we talking? What's the chances of that happening? Are you giving us a range? What's the growth going forward? And it seemed like maybe China and other countries, I think we've just seen it with the Philippines actually. Indonesia basically said that, it's just shut the door on Temu. I just thought, you know what? I'm going to walk away here. I've got Alibaba. That's the Chinese stock that I'll hold for longer term. And the stock rallied up basically, and I was back break even on my position, and I thought, okay, I've got the chance to get out break even, I'm going to take it. I've got to say the last kind of like couple of days it has gone a little bit higher since I sold, but I'm fine with it because this is just, short term, and there's nothing fundamentally really moving that price back up. When the stock was actually fundamentally performing, the stock basically didn't do anything. So it is what it is. There's always that chance that sometimes you release it and it goes up a little bit more, but for the long term, I'm sleeping a lot better with PDD not in the portfolio. So yeah, I did release that position anyway. And that's it for today, guys. That's all the stocks that I bought and sold from the 1st of September to the 1st of October. Hope you enjoyed the video. If you could, hit the like button. If you're new around here, subscribe. And don't forget, on Sunday, I will drop a live Q&A session on the main channel to celebrate the 16,000 subscribers. But I will also do a video on Patreon on probably Saturday. So if you do want to see that, link's in the description. Apart from that, guys, have a great weekend. I'll see you on Sunday. Thanks for watching.